last bull run has pulled many new investors to equities, thanks to the efforts done over years in educating investors towards equities. But year 2022 has not been an easy year, but a year that requires experience and maturity to pass this phase wisely. So the final panel, ladies and gentlemen, for the day is going to discuss investing do's and don'ts for a year like 2022 when stock markets look attractively valued and scary at the same time. We have eminent panelists joining us, and let me take the privilege of introducing them to you. We have with us Mr. Aashish Somaiyaa, who is the CEO of White Oak Capital Management. At White Oak, Mr. Somaiyaa is responsible for managing and growing its operations. In fact, he's an experienced professional and has experience in scaling up and managing relations across well-known AMCs like Motilal Oswal AMC and ICICI Prudential AMC. With a master's in finance and bachelor's in science, he brings 2 decades of industry experience. He has been responsible in the past for sales and distribution of one of India's largest AMCs, ICICI Prudential AMC, for their mutual funds, PMS, and real estate offerings through multiple distribution channels across India and the Middle East. We welcome him warmly. Mr. Aashish Somaiyaa is here with us. Ladies and gentlemen, we also have Mr. Anunaya Kumar on this panel, and he is the Senior Executive Vice President and National Sales Head at IIFL Wealth and Asset Management. During his professional journey of more than 2 decades, he has held several senior leadership positions with banks and asset management companies, and has managed relationships across B2B and B2C verticals. He has successfully managed the corporate banking, retail banking, and wealth management profiles for banks before joining asset management companies and heading their strategies and sales verticals. He's an MBA in finance and a commerce graduate from Punjab University, and we extend a very warm welcome to Mr. Anunaya Kumar. We have with us Mr. Shahzad Madon, ladies and gentlemen, and he's the head Nippon India Alternative Investments. Now, Mr. Shahzad Madon is the head of Nippon India Alternative Investments, as I said. He comes armed with more than 30 years of industry experience across the investment management and financial services sector. Mr. Shahzad has held various responsibilities, which include heading equity research, managing equity portfolios, managing portfolio management services, and setting up and driving the alternative investment business. He joined Nippon India in 2010. In addition to equity, since then, he has been instrumental in introducing various asset classes, including real estate, high yield, credit, and venture capital. Mr. Shahzad leads a team of investment experts under various asset classes, which is equities, credit, real estate, and venture capital across both listed and unlisted investments. He's also one of the few investment professionals who has experience across both the listed and unlisted space, which gives him a unique perspective towards any investment. Prior to joining Nippon India, Mr. Shahzad was Executive Director at ICICI Prudential AMC, and he has been involved with the real estate industry since 2005, 2006, and has been the guiding force behind the launch of the first ever real estate offering via the PMS route in India. He had been actively involved in the conceptualization, fundraising activities, and fund management of this real estate offering. While managing this fund, Mr. Shahzad has had the opportunity to do a variety of real estate deals across equity, mezzanine, and debt space. He was also responsible for an exit, which was amongst the first few exits in the industry. During his current stint with RCAM PMS, Mr. Shahzad has overseen various deals in the real estate space involving varied developers and geographies. And we extend a very hearty welcome to Mr. Shahzad Madon. Ladies and gentlemen, the moderator for this session is Ms. Ami Shah, Senior Assistant Editor, ET Prime. Ms. Ami Shah is a business journalist with nearly 2 decades of experience. She has worked across the media spectrum, news wires, newspaper, and the digital space. Currently, she's a Senior Assistant Editor at ET Prime. Her previous notable stints were with Mint and Reuters, and she holds an MBA in finance. With that, a very warm welcome to our moderator, Ms. Ami Shah, and it's now over to you, ma'am. Take it away.
Thank you, Aishwarya. A warm welcome to everyone to this session of PMF AIF World Summit. Not long ago in our living memory, we saw the biggest bull run ever. Retail investors flocked to the market like never before. Sentiment globally went full throttle with the liquidity tap. And while we battled the pandemic and were holed up in our homes, one silver lining was super returns from the stock market. Cut to present times, Markets have corrected. Inflation is sticky everywhere. Central banks have turned hawkish. Russia-Ukraine crisis continues. Rupee is hovering around record low levels. This brings us to the topic of today's discussion, one that is probably playing on every investor's mind. What are the investing do's and don'ts for the year like 2022? Um, to start with, my first question is to Ashish. Ashish, if you look at valuations, they are at multi-year low. Macros, as we just discussed, aren't very promising. Interest rate trajectory is not found. How are you navigating the market at such a time?
Yeah, thanks, Ami, and thanks everyone at PMSAIF for giving us the opportunity. Uh, so, Ami, when you said macros are not looking promising or not looking great, I think one has to really divide it into two parts and look at global macros separately and look at India's macros separately, right? India's macros, if you really ask me, post-COVID, have started to move for the better. In fact, we are better than any time that we were, if you were to compare this with the pre-COVID scenario. On the other hand, global macro, especially if you see US, which is one of the largest economies. So if you take US a little bit as a proxy for the moment for global macro, then US macro was actually the opposite. Pre-COVID, they were literally flying, 21 trillion economy, growing 3.5%, and practically zero unemployment. So pre-COVID, and 10 years before pre-COVID, they were literally flying, and they had like a great boom. On the other hand, if you look at India, post-COVID, we have improved a lot, and pre-COVID, we had actually disastrous economic performance. A lot of people today, if you ask them, their big concern is US economy. I would just put a simple thing that 2010 to 2020, if US was booming, why did we do so badly? We never participated in that boom. So the answer will be that, no, our fortunes are linked to our domestic circumstances. So that pretty much stays. I think our fortunes are linked to our domestic circumstances. That's how we should look at it. Of course, right now, the US monetary policy is in a transition, and during a transition, it's but natural that, currencies and interest rates will fluctuate or move around a lot. But ultimately, currencies and interest rates and a lot of macros, or even the stock market for that matter, will settle down to reflect our domestic conditions, and theirs will settle down to reflect their domestic conditions. So I think this is a transitory phase we are going through, not to read too much into it. And in my past experience, whenever foreigners have sold heavily because of global conditions, thereby suppressing our valuations, like you mentioned, in hindsight, it has always turned out to be a fabulous investment opportunity. So how do we capitalize on this is what we should be more mindful about. Last thing I'll tell you is that, 20% up or down in any given year is par for course. The beautiful thing about 2022 is that the 20% down has come in the first 6 months already. We've crossed the trough now. From here, I'm reasonably certain it can only get better.
Thanks, Ashish. Thanks, Ashish. Shahzad, similar question to you. How are you navigating the market, and also are AIFs more vulnerable to market volatility in a downturn? And how are you strategizing that part of your portfolio?
Sure. So let me start off by saying I would endorse everything which Ashish said, is that India looks in a stronger position than ever from a fundamental perspective. Certainly post-COVID, uh, I think we look to be in an extremely strong position. You look at all the indicators and they look very promising. Also, in terms of the monetary policy which we have very little else to do relative to the rest of the world in terms of where we stand. So from that perspective too, we should look good. Valuations are middling, reasonably attractive, and this is what it is. So fundamentally, what would we do is as follows. I mean, simple, stay diversified. Firstly, it's not too different from what you would do as an investment manager. You always need to exercise prudence. You can't get carried away anyway. uh, Stay diversified. That's very, very important. Don't bet the ranch on any single sector or stock. So staying diversified is point number one. Invest in fundamentally sound companies, which in any case we should always be doing, but that puts the question which even more. So focus that much more on good sound companies and at reasonable valuation. So the situation of growth at any price, people buying stocks just based on valuation doesn't matter, etc. I think is quite clearly behind us. For a lot of managers, including ourselves, that's never something we subscribe to, but that is something which is very, very much behind us. It's quite clear. So very clear, very stick to the basics. Things are good. From an investor's perspective, I would just like to say, because this is from an investment manager's perspective, from an investor's perspective, I think stay balanced. Try to keep the noise out of the way, because the more noise one gets, the more one gets sort of impacted by what they see and hear, which is not I wouldn't blame anybody given the decibel levels and a lot of the negativity especially which goes around. That's important. And take as much risk as your let us say your appetite permits you to do. Very, very simple things, as long as you do something like that way and do nothing silly. I think that's very important, because if you do nothing silly, history in India suggests that by and large, you have empirical evidence suggests that you have done well. Okay. Now coming to the latter part of your question, the latter part of your question being, are AIFs more susceptible? So I'll answer it in the following manner. Firstly, there is no, AIFs are not a homogeneous whole, right? They are very, let us call it heterogeneous. So you have different types of AIFs. You have AIFs which are, all different asset classes. If we are talking on the long only equity side, which I imagine is the main objective of the of your questioning, that clearly would be, I do not believe it is any more risky than any of the other vehicles, which is primarily typically a mutual fund or a PMS. In fact, one could argue, given that most long only AIFs are in a close-ended format, you could actually argue that you are probably better off, because you are not facing redemption pressures and none of the other pressures which you might face through some of the other vehicles. So given that long only perspective, I don't think you are that much more, you are exposed to any further risk through an AIF route. On the other asset classes, that's a different story, but I imagine we are not to touch upon that at this point in time, unless you wish me to.
That's good for now. Anunaya, coming to you, you are someone who's in touch with clients more than anybody else out here. What are the feelers you are getting from them, and what are you advising your clients at this point in time? And also, another part of the question is, what is the historical trend on drawdown, and is the current time any different?
Good evening, and thanks, Ami, for the question, and thanks PMS AIF for giving us an opportunity to come and give our views. Now, getting back to your question, let me tell you that, for example, in fact, we in IFL Asset Management are into actually B2B, not in a B2C. So hence, I understand your definition of a client are intermediaries. That's the way we look at it.
Right.
Coming back to what are we talking about, I think Aashish and Shahzad has very, very nicely summarized it, and I think our definitions or our views are no too different from what they have just said. The key to the success in these markets are twofold. One is the client profiling. You should be knowing what kind of risk that you would really want to onboard, for what duration you would want to onboard the risk, and what kind of return expectation that you are looking at. If you have done the profiling well, if you really understand yourself pretty well, then I think these are the opportunities when you can actually add assets when you see the drawdowns being in the market. And good assets at a reasonable valuations, if are available, I think no better time than the times of today to add them. Second, aspect that one should be looking at is from the, or rather the later part of the question that you have asked, is the times of today any different from what we have seen in the past? I would say not too much. If you go back in the last 40 odd years, we have seen the markets behaving, at least the drawdowns being in excess of 20%. There have been 7 occasions, and right from 86 to 88 to the latest one, which was in 2020 that we have seen, which was actually the shortest of all the drawdowns that we have noticed. And I'm talking about a drawdowns being in excess of 20% kind of a fall that we have seen from the peak. what we have noticed is after each of these drawdowns, 7 drawdowns that I have spoken about, there have been a phase of a decent upside and a bull run that has got noticed. The largest one, if I talk about, I think was in the year between 2013 to 2019, or rather 11 to 19, around 8 odd years, where one could see a compounded annual growth rate of around 12.5% to 13 odd percent. And if I talk about the shortest one, I think was around 90 to 95, which lasted for, I think, some 16 to 18 odd months. But the returns during that period was close to 81% kind of a compounded. But that's the various phases. But if I look at if I draw a summary of the 40 odd years, what we have noticed is an average duration for a bull market is close to 4.1 odd years. And an annualized return that one can look at during these bull phases, and again, I'm talking about average of last 40 odd years, has been close to 37%. Likewise, if one goes to the bear market, I think it's been around 15 odd months being the duration, and the drawdown is close to 36 odd percent. So what are we talking about? Basically, talking about at every 4 year, if you look at it, you have a year where the market actually takes away your contribution of out of the 4 years, 1 year contribution market takes away. So you have the 3 years contributing, 1 year taking away. So that's being an experience. And I think, as Aashish rightly said, if one can see that the markets of today, already we have seen the markets coming down to a valuation. And again, if we look at the valuations on a price to book, what we have seen is that the markets generally, maintains a price to book of at an average of 3.1 kind of a level. If I add a standard deviation plus 1 minus 1, I'm talking about a 3.8 to 2.4, and that's being the range. Market as we talk today is actually at a 3.1. The beauty, Ami, is that if we look at the way the market spends time, normally as you get closer to the lower end of standard deviation, the duration that the market spends is less than 5%. Likewise, if you go towards the upper end of the curve, which is 3.8 and beyond, again, market spends close to 11%. So if I take away those, aberration of 11 and a 5, 16, so 84% market actually spends the time between 2 and a 4. And that's where, if you have seen, the median returns are close to 12% actually, which is what all our advisors, when we go and set expectation to the investors, what do? We actually go and tell them, look, equity is a great asset class. You should look at between 12 to 13% kind of a return. But there is a science to it, because market actually spends 84% of time generating this kind of a return. So to me, I think if I look at it from a price to book value, we actually are at a 3.1, which is the average of last 20 to 23 odd years. So that way we are neither expensive nor we are cheap. But yes, you should be hearing your advisors, and as per your risk appetite, your profiling is what you should be taking the decisions.
Thanks, Anunaya. That was insightful. Shahzad, my next question is to you. Historically, we've seen that drying up of free capital has spelled doom for growth stocks. I mean, growth we've seen a hard landing in the US. What are the lessons for India? And this is also in light of, we had euphoria in the startup space, and then the meltdown. So if you could, your thoughts there.
Sure. So let me try to answer that. As Warren Buffett says, interest rates are a force of gravity, and that really, in many ways, brings rationality into a market. So the central bank propelled bull rally which you had, a bull market which you had, made money cheap or free, and on account of that, not very wise things happened. A fair amount of silly things happened. Okay, be that as it may, nothing lasts forever, and I think the fact is that a lot of valuations, etc., are let us say reality is dawning. You've seen that very clearly happen in the let us say in the Western world. You've seen what's happened in the Nasdaq, where you had listed stocks, etc., and we're talking about large mega caps. I mean, I'm talking about the Netflix and the Zooms of the world, etc., which have corrected close to 70%, etc. Okay. India, to that extent, has been better off. It's not that we've not had our issues or not had our corrections. So if you look at it, a lot of stocks around 20%. If you look at it more in the new age space, that's been down even more. But I think the important thing is, again, it's good old-fashioned stuff, which is focus on businesses, focus on cash flow. There is nothing like growth at any price. That thing is, it's nice, it's faddish. But, at the end of the day, the reality is cash flow, and that dawns on us every few years, and that is something which happens. The On a lighter note, the only good thing I will say in this is that while there are domestics in it, see the lot of the, if you want, the damage, if at all, in terms of valuations, is primarily on the stock market. It's reasonable, as pointed out by my colleagues. It's, market down 20%. I don't think anyone should be surprised. If you come in this game, and by and large, most of us have been here for long, and most of the investors and most of the money has been for a fair period of time, I don't think they are unnerved. That is proven by the fact that there is a fair amount of the domestic mutual fund money, which calls the typical Indian investor, continues to come in strongly. So I think the Indian investor, the local investor, is pretty happy with what they've seen. When you look at valuation corrections too, the valuation corrections primarily have been in the late stage growth, right? So when you look at also the value in new age stocks, it's not so much in the, right at the startup stage, right at the early stage, or what may be described as Series A. It is more at what is Series D, Series E, pre-IPO, etc., where there are significant corrections in valuation. So, I mean, taking global names, there is a company called Klarna, rather, which you have obviously heard. So they were talking about a 45 billion valuation, and now the next round is happening at 6 billion. Right? So stuff like that is more happening at the very, very late stage. It's not happening at the earlier stage. On a lighter note, I think the good part, I would say, that it's not that locals have not lost money, but a lot of the damage has happened with overseas money. And typically, most of those guys have been there for a long time. So some of the names, especially the storied names, I don't need to take the names of those AMCs, they've been in from an early stage. Yes, so there is a moderation in the number, but I don't think that's hurt local investors too much. But to come back to what's the lessons to learn, investing is good old-fashioned business. Don't do anything cute. Don't do anything stupid. Focus on the very basic stuff, and you should not be hurt. I'll just say this: bank on India, like Warren Buffett says, bank on US, bank on India. Just stay there. You won't be disappointed.
Thank you, Shahzad. That was interesting. Ashish, your thoughts there. What are the lessons that we could learn from the meltdown in the US tech sector and what happened in our country with the new age companies?
So, I think that the kind of meltdown in tech stocks clearly started, first with the political interference in China, right? When, the Alibaba, the IPO was kind of, Mr. Jack Ma kind of disappeared and the IPO was cancelled and stuff. And, when it comes to ed tech and gaming companies, there were a lot of pronouncements which were coming out of the Chinese market. So first it was that China meltdown. Then followed, of course, in sympathy, empathy, whatever you may call it, the US tech sector also kind of saw a significant meltdown. And in sympathy with all of that, obviously in India also, you can see clearly that the tech sector has taken a beating. But what is weird is that the tech sector across the board has taken a beating. For example, if you were to take calendar year 2022 and you take the worst performing stocks, I don't know what is it as of 7th July, but till last month, if I'm not wrong, if you take the 10 worst performing stocks in India in calendar year 2022, 6 of them would be mid-cap IT companies. Okay. So 6 of them would be mid-cap IT companies and 2 of them would be consumer tech or whatever you call in India. So I would say 2-3 things. In my previous response also, I said, so let me put it this way, that when you look at spirituality, in spirituality, you are taught that all the answers lie within. सारे सवालों के जवाब आपके अंदर हैं. I always tell people, don't apply that logic to the stock market, because in India what happens is that if something happens in China, something happens in US, we try to look for reasons within our borders. Correct. Now every time the Indian market declines 20-30%, if you ask me, the biggest FPI flows happen when there is a global crisis. Let me contextualize this. 2015, 16, 17, 18, and 19, India's corporate performance and India's economic performance was pathetic. In those years, if you take 12-month rolling average of FPI flows, it kept fluctuating between $2, $5, $10 billion here and there. Okay. The big FPI outflows never happen because of India. The big FPI outflows always happen when there is a global crisis.
Sure.
And most crises emanate out of the larger economies, which is US in multiple instances, and which is China twice in the last 5 years. When there was first a Chinese slowdown and a commodity crash, and now COVID and all these things. So the point I'm trying to make is that where is India's economy? Where is India's market? Also, equally importantly, since your question was on the tech sector, The point is where, why is everything in the tech sector down 40%? That kind of, we really need to think about it. Of course, valuations went up after COVID, then valuations corrected. We can always quote all the numbers. But the point is that to the extent that it started with China and then US and then spilled over to India's tech sector, and in 2022, the worst performing stocks by a mile are only tech stocks. At the same time, it's not like there is some pathetic bearish guidance coming. In fact, all the reports from US say that actual tech spending is not going to go down. Whenever there is economic slowdown, whenever there is a COVID, tech spending only goes up actually, because everybody looks for productivity and efficiency, right? So, what I'm trying to say is that I don't think that India's tech sector, the drivers of India's tech sector are not nearly comparable to what is happening in US or China. The stage of evolution in which our tech sector is, the stage of evolution in which our consumer tech, ed tech, med tech, fintech, whatever you call it, our stage of evolution is very different from US. And the last thing I'll tell you is that before COVID, if you take NASDAQ, the 10-year compounded, the 10-year CAGR of NASDAQ before COVID in rupee terms was 25% compounded. In dollar terms, I'm sure it was 20% compounded. We were not, we didn't come off that type of crazy bull market. So I understand why pre-IPO companies or freshly listed companies, why they have collapsed. I completely understand. It is related to what Shahzad just mentioned. It was basically momentum investing, right? That because everything is in a teji, so let me just buy the stock now. It will get listed in 6 months and I will make 30-40%. That was greed. That was momentum. That probably deserved to get corrected. But to the extent that we are just kind of, not only empathizing, but we are sympathizing with China and US, I think to that extent, it's kind of overdone. And we should be able to see where India's tech sector is, what is it composed of. Even if you ask me about new age companies, what is our stage of evolution? Did we see a kind of 10-year bull run like what US has seen in private equity and in NASDAQ and all those kinds of things? So our market is different. Why I gave example of crisis and crisis related FPI outflows is because, we seem to be overly driven by what happens in the global market. I can be reasonably sure from past experience that as soon as the dust settles, you will actually see things flying.
Sure. Thank you, Aashish. And moving on to investor psychology, investor behavior. Anunaya, my question is to you. A lot of new investors ventured into the market over the last 2-3 years, and when most of these are millennials, Gen Z, and when I talk to 20-somethings in my family, for them investments are all about equities and cryptos. Fixed income and gold do not figure on their list at all. Do you think the latter two should be a part of most portfolios, even at a younger age? And what are your thoughts? And how does one convince this category of this age of investors to offer them?
Yeah, I think it's a great question, and it also talks about the behaviors that that's getting witnessed today. The thing is, the new millennials that you're talking about, this generation is in a great hurry to create wealth. So they don't have the times. What we keep talking about, that you need to carry patience, you need to give some times, and you need to carry those troughs and the crusts of that market forms for you to start getting the benefits of dollar cost averaging, and then you start building the corpus, which is where your aspirations and what you are looking forward to should get delivered. But this generation is very different. Now, let me give you some stats. If I go back in the last 40 odd years, if I look at the inflation at an average has been close to what? I think 7.8 to 8 odd %. What are we aspiring for? We basically look at that, the asset classes that we should be investing, should beat the inflation. Or if not at a asset class level, at a weighted average, at least I should be able to beat the inflation, because inflation does nothing but eats away the real value for money. You'll be surprised to know that the gold in those same 40 odd years have delivered close to 9.7. Your PPF, which is normally a proxy to the deposit that one look at, has been close to what, 9.8. Undoubtedly, equities, if I take away the dividend contribution, I think Sensex had delivered close to 15.5. So yes, when we look at building, that's what we talk about an asset allocation, because the moment you come lower the, your return expectations, what are you trying to do? You're trying to build hedge. You're trying to build the cushions in the market, in the times when the market starts showing the drawdowns, for whatever reasons. But yes, you would want to build some cushion for those times. And which is where we say that yes, asset allocations makes a lot of sense and you should be able to know. Now, getting back to your core question, which is the millennials, the good part for millennials is that they have the working age, long enough in front of them. So obviously, that makes their ability to take risk in a little but can something justify getting into cryptos and all? I think I will rest my case. I don't want to comment because there are enough and more available in the public domain. And since I don't consider myself as an expert on crypto, so I would, resist commenting on that. But I think we all have seen what is happening with the company. They're disappearing overnight and all of that. But as long as you take away those kind of asset classes, out of the picture, then you would want to look at it. I would say yes. If you're in early stage of your career, you should be a little higher on the equities, and likewise, you should build a portfolio with a hedge. Whether you would want to build a hedge in the form of gold, which is nothing but hedge against uncertainties, and more the uncertain times, you would want to see some kind of hedge gets built around the gold and all. Your non-equity, or I would rather say the deposit, PPF or the FDs are largely, a contracted approach that you take in terms of, yield formulation and all. But what you can also do is within the deposits, within the fixed space, also you can look at taking your guard on the risk appetite slightly higher. So there are a lot of stuff called a structured credit, for example, which is available on an AIF platform, where you do nothing but actually you go and structure a credit in the form of a LAS, where you can, or a corporate guarantee, where you can look at, having the right set of covenants so as to mitigate the risks, and the return expectations can be in the northwards of 10, 11, 12, and you can be looking at. So within the non-equity, in the fixed space, in an income space, also you can build aspirations or build a little better return expectation, looking at what kind of risk even over there you would want to take. I'm not for a second talking about unsecured, but I'm still, all my comments are within the secured space that I'm talking about. So yes, that's where it is. My sense is asset allocation across the time frames are the critical, and that's the only thing which can, in a meaningful way, create the wealth. Asset allocation is a function of your age, what age you are in. Earlier, higher the allocation to equity. As you go advanced, then obviously your wealth creation aspiration starts moving into wealth preservation aspiration. And that the transition of a creation to preservation does nothing but your allocation to high beta space that starts diminishing, and that's the way it should be looked upon.
Thank you. Aashish, similar question to you. Currently uncertainty seems to be the flavor of the season. Interest rates are rising. And also, if you look at the available asset options, we had cryptos which got popular like around 5-7 years ago. And now a lot of things have changed in terms of investors' options to invest. Suddenly, people are tapping the unlisted market. Do you think it is the right time currently to revisit one's asset allocation strategy, given the changes around us?
Yeah, so there's no doubt, Ami, that at any point in time, any investor, maybe, at a pre-specified periodicity, which may be, say, 6 months or 12 months, of course, not too frequently, but say maybe 6 months or maybe even 12 months. I think that's probably a right frequency to keep revisiting your asset allocation, maybe even irrespective of what options are available or whatever may be happening. So that is, kind of standard prescription. Anybody who is investing for any kind of goal and who's following some asset allocation practice should certainly review it, right? Now, I think currently, if you ask me what are the triggers for reviewing this, obviously, like you said, interest rates, the inflationary trends, market valuations. So there are multiple triggers for this. And I would say that definitely it should be reviewed. It's just that when you are reviewing your allocation, there should be some rules around it. So rules meaning that there is a targeted allocation. Let us say you think that equity should be 60% of your portfolio. Then obviously the events of the first half of 2022 would have made that 60 to come down to 50 or maybe lower, right? So if you are somebody who's reviewing your asset allocation, following it strictly, then not to interfere with the rules. And this is a time to actually rebalance in favor of equity. That's how I would say. I'm sure you would have got the drift by now about what I have been talking. But I think yes, this is every 6 months, every 12 months, one must review. And right now is a good time to rebalance in favor of equity. I think that's how I would put it. The other important thing, of course, is also that if there are just two markets in the whole world to invest in, for me it would be India and US. So a lot of people right now will not be in favor of investing in US or not be in favor of investing in, say, for example, global emerging markets also. So I think these are some things, asset allocation demands that your actions are slightly counter-cyclical and you should never overrule the framework. So any change in asset allocation would demand slightly counter-cyclical behavior, whereas your emotions might prevent you from doing that counter-cyclical action. So I think that is something important to keep in mind, apart from just the rebalancing and the frequency.
One follow-up question to this, since you mentioned, you would think India and US are the good investment destinations. Over the last few years, we also saw, ability of Indians to invest in foreign markets, ETF route, be through direct stocks, fractional stocks. How important and how inevitable is that diversification within equity space, that investing in a foreign market as well alongside Indian markets? Aashish.
Yeah, I think investing in equity outside of India is a must for everybody. I mean, of course, I know that we have regulatory rules, regulations, etc. So either you go the ETF route or you go, through active funds, depending on whatever capacity is available based on RBI and SEBI regulations. And if not either of those, then you figure whether you can buy stocks or, you can do through LRS or whatever it may be available to you. But I think keeping aside the availability and keeping aside the regulations, on a more fundamental basis, Indian investors are obviously overexposed to India. First of all, within India, they are underexposed to equity, but within whatever is there in equity, we are overexposed to India itself.
Correct.
But we also know that however diverse and however deep the Indian market may be, the fact is that there is a bunch of technology. See, US, it's the mecca of investing, and it's the capital of innovation and whatever new things happen in the world. Plus, a lot of companies in US are truly global in nature. So even if you want to invest globally, US is the place to be in. So any equity investor, India is something which is going to give the best growth opportunities in the next 10 years. But there are very many opportunities which you cannot capture just by investing in India. So US is a must for its own merit, plus for a global exposure. And the third thing is that even within emerging markets, there are many emerging markets outside of India, which can add complementarity in your portfolio. For example, markets which are driven by commodities, markets which are driven by oil. For example, South Korea and Taiwan markets are heavily into technology, right? So there is a plethora of things that one needs to get exposure into the portfolio. There is a plethora of things that one needs to complement India with, so that you can cut down your downside in adverse market circumstances. So I think any well-balanced portfolio should have all these three exposures: India, global emerging markets, and US. All of them. Of course, I'm not getting into country-specific issues. I'm just talking more broadly at an asset allocation level. And I think all these exposures are a must.
Sure. Thanks, Aashish. That was insightful. Shahzad, coming to you, do quality companies look overpriced at this point? And is quality still a relative safe haven for equity investors, or is it out at this point?
I mean, there are a couple of ways of looking at this. See, normally when one talks in the context of quality, over a period of, let us say, the 4 to 5 years, which is about 2015-16 to 2020, there was a certain set of stocks which sort of fitted a definition of, or the current wisdom, I would use the word, the current wisdom of the market of what is quality. So typically they were stocks which were very high PE stocks, which had a degree of certainty of growth, no doubt, and which had grown very well, good ROE, good ROC. But question is, and those stocks, well, continue to do very well. That possibly was on account of a fact that a market was very narrow at that point in time. So at a point in time, when the market was narrow, when there were maybe lesser opportunities, there were certain sort of stocks where a lot of the investment money congregated to, or went towards, and that created, these things are a nice bubble of their own because more money follows it, more money comes in, and so on and so forth. So, so let us look at quality from that paradigm, right? So this was the, let us say, the definition of quality. So buying growth at, or what was perceived as growth, a lot of them were not even very growthy companies, buy growth at any price, okay? That worked for a period of time, like anything, but at some point in time, you've seen over the last about, I would say, 24 months, that strategy has come unstuck, right? Needless to say, anything which is overdone in markets typically comes unstuck. Okay, so that is one, let us say, way of looking at quality. The other way of looking at quality, and it often, I find this rather strange, that the definition of quality keeps changing, right? So, jo chal raha hai, wo quality ban jata hai, right? I mean, when paint companies were doing well, wo quality the, right? When finance companies did well, those were quality. So what is quality? Is a steel company which has survived for 80 years not quality? Debatable, right? That also throws out a lot of money, except that it's cyclical. So, let's just say that in a market, we should always try to take a balanced view. Fads come, there are certain stories which, let us say, get popular at points in time. Those stories take a life of their own. Most people move towards it. The entire press covers it, and so on and so forth. Certain managers play that very well. In the US, we've seen Cathy Wood play a certain sort of stocks very well. Worked very well for a point in time, right? Will it work forever? Nothing works forever in this market. I think the fact is that you need to, again, same old-fashioned things, be diversified, by reasonable growth at reasonable price. It's not that we are also not value investors. We are growth at reasonable price investors, but we are not growth at any price investors. So with that, I think the value bit has come unstuck for now. But like I said, you need to just keep that at your back of your mind and keep trying to, let us say, separate the story from the real underlying. And the story was that, just buy those value stocks, they'll work. It doesn't work like that, right? And we've seen that happen. So, so that's.
Thank you. One question to start with, to Anunaya. What are the emerging new trends that you see that would define the market for the next 1 or 2 years?
I think a great question. The beauty is, what do we mean by the trends? As Shahzad very rightly said, many of these trends are the fads. So, jo chal padta hai market mein, that becomes a trend. Sometime back, it was a specialty chemical company. People built a nice stories around China. A lot of businesses are moving out of China, and that's the way the specialty chemical businesses, APIs, and that became the trend. Crude started easing off. The paint businesses became a great trend. The crude started moving on. Then your refinery GRM became a trend, and then people started looking at all refineries, and they said that's a great company to look at. I think many of these things that we talk about are the time statements. And to me, I think what we should be largely looking at is the pattern. And to me, consumption, if one looks at the consumption as a pattern, there is no two ways about it that, yes, consumptions, anything related to consumption and all has a great market. For example, today, if you would really want to look at buying a car, you have a minimum waiting period of anything between 6 to 9 odd months. There are launches which are happening in the super luxury spaces where the cars haven't yet come in the country, yet all the bookings are done for next 1 year just by looking at a photo. So that's the trend. So do you actually call it a trend? So can auto be the trend? Answer is why not? Auto can be the trend. Like the auto is a trend, that all the industries which are related to auto, like a tire, battery, can that be the trend? Answer is why not? Even that can be the trend. So we are talking about the consumption. People have started graduating from a 1 BHK to 2 BHK, 2 to 3 BHK. Can housing be a trend? Yes, that can be the trend. Now, if housing becomes a trend, can all the ancillary units which are related to housing, from a ceramics to cement to everything, can that be the trend? Answer is yes. So it's a very broad perspective. It's very difficult to say that at any point of time, look, these one or two sectors are now going to lead the show, and what that's the way you should be looking at it. Yes, there are the times when market shows its own behavior, and normally those behaviors can get defined with a beta, non-beta, and all of that. So generally what one notices, that whenever the market starts looking at the beta as a space, then all the interest sensitives and all of those starts looking pretty good to go. And then when the market takes a little defensive approach with a low beta approach, and your IT companies, your pharma companies, those become the flavor. But I still wouldn't want to paint any of these aspects or a brush to say that this is where the trend is. To me, I think the consumption is supersedes everything. I think India is a great consumption-oriented market. That actually is key reason which attracts all these FTIs and all those global overseas player always looking at India. So I think all those businesses which are related to consumption, that's one. And to me, I think with the impetus, the way the sound bites which are coming from the ministry of, or the government circle, which is on the infrastructure, I think the sector related to infrastructure also to me is a great one, because today only actually we were reading it, an article came in, Mr. Gadkari had gone and said that, next 5 years, the petrol will become a history. So now we're talking about combustible engines are completely moving out of the show. So the electric vehicles will now be the new trend to look at it. But yes, I think infrastructure is to me, I think consumption and infrastructure, these two, if I look at the broader approach, I think these two are the ones probably which will rule the roost, at least for some more time. And I have no doubt about that.
Thanks, Anunaya.
Ami, may I, with your permission, may I add something to that?
Please, please.
Sorry.
Please
So I just thought I must add this, and it's also making a pitch for our industry. And I believe it's actually a trend which is visible, and at least we believe at my organization strongly that will play out. See, there are, if you look at the overall investment management industry, this is slightly different, not talking on sectors per se, but on our industry, let's say. If you look at the industry, what's happening to the local industry, SEBI is rightly on the MF, let us say, is in terms of a regulatory environment, the MFs are getting increasingly more regimented. There are more regulations coming in, which is all very good, and that helps an industry scale up. So we are all for that, right? So large caps can only do this, mid caps can only do this, multi cap can only do the following. So the degrees of freedom, so to speak, are getting constricted, which is great, because as an industry gets more, grows, and it reaches the far wider audience, you need to be able to, everything needs to be true to label, everything needs to be completely exposed. So that's one trend. Then you have the ETF side, which is the other part. So ETFs generally also globally are eating into the management of active. If an individual is looking for alpha generation, which a lot of our HNI investors are, so for all the panelists out here, everybody has HNI investors and all participate in the PMS and the AIF space. For those who are seeking alpha generation, and I use the word potential because there is no guarantee that you can give it, right? Sure. The place to seek that is going to be PMS and AIF, and we've already seen that. So because you have a greater, let us call it an ability, a flexibility to deliver that, investors will seek that, and that is what will happen. So we see that happening. If you see the growth of the industry, you see a lot of managers too, now senior managers setting up on their own. What is it? What is the intention? The intention is that we believe that we've got a good track record. We want to give in a platform which we believe we can deliver alpha. So my sense is that is a trend. And if you look at the West, Aashish rightly said the Mecca or the home for all investment management comes out of, say, US. And if you look at that market, so there are very, very large players. There are guys who play ETFs on a very mega large. There is active managers, and then there is a call it boutique managers by whatever names called in that market. And that's huge. It's not just a few guys, it's hundreds of them and all doing a good job. So our sense is that part is going to grow as an industry. That is something which will certainly play out, which is good for all of us and is good for all the audience too, because their investors will have that much of a more choice of managers to select from. So I'll leave it at that.
Great. Thanks, Shahzad. Thank you. As we come to the close of this session, one concluding question to all the panelists. So, you know, an average retail investor, specifically the one who joined the markets in the lockdown, was only used to seeing the prices go up. And last 6 months have dispelled a lot of myths for them. What is the one concluding advice you would want to give to the average retail investor? Ashish, can we have you first?
Yeah, Ami, I'll just add to that or modify a little bit. Actually, if you ask me, a lot of attention on capital market adaptation and digital adaptation during COVID. But if you just dial back a little bit, you will notice that the actual spurt or growth in mutual fund SIPs and in demat accounts actually started happening post demonetization, because that was our first brush with being forced to go digital and being forced to put money in the banks, right, and come out more in the formal framework. So if you ask me, there is a lot of expansion which started happening from 2017-18. There is clearly this one cohort of investors who I have dealt with extensively and also held hands with in 2020. So there is this one cohort of investors who thinks when 2020 came, all the guys who came in 2017-18, they would have by then decided, because 2018-19 was bad, and then on top of it COVID. So all the people who came in 2017-18, they might think that this place is just not for me. And all the people who came in 2020, they might think, what is all this song and dance about? It's so easy. So the obvious point is that it's not as difficult as it appears to the guy who came in 17-18, and it's not easy as it appears to the guy who came in 2020.
Absolutely.
Right. The point, and the other thing is that sometimes when we do well, we have the habit of associating it with our skills and our individual brilliance. But sometimes it's just the market doing something for you. So don't never mistake a bear market for lack of competency, and never mistake a bull market for brilliance. That's what I would give a food for thought.
Thank you. Shahzad, similar food for thought from your end to the retail investor.
Okay, on a lighter note, I'd say the following. Let's see, by and large, like a lot of the guys, and when you spoke about crypto too. So while, yes, there were a lot of investors in crypto, by and large, छोटा अमाउंट सबने डाला था, 10,000, 25,000, 50,000, सब well, young guys, I have relatives, first salary उधर डाल दिया. The good part is, sorry, it sounds very cynical or nasty, but the good part is you'd better lose money at the early stage when you put less money in, rather than put big money and so on. So my experience, on this market too, and so on. I don't think it's the 40, 45-year-olds who have lost too much money, because by and large, they've been investing in the market in a gradual way. A lot of the guys, the new age guys, jisko rocket sursuri sab chahiye, those guys who've come in later, those guys have got hit. And sorry, I don't mean to be again rude or, and laugh at anyone's loss, but a little bit of getting chastised doesn't hurt. And the better part is the early part of your career, because मतलब अभी थप्पड़ खा सकते हैं ना यार 27 years पे, मैं 57 years पे, the ability to take that is a little less, right? So from that perspective, I think a lot of the guys who got hurt, it's that's cohort, not the, let's call it, the more matured investors. Baki, I think it's investment in many ways is very it's simple. It's not easy, but it's simple, which is just do the right things, stay the course. Right, stay the course always. That's very important. Be balanced. Don't be too greedy. Don't do anything very stupid. All very, 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 very basic things. And then very, very important. And I do believe this, that don't bet against India. Right. I'm borrowing this Warren Buffett statement, who said 2 sessions ago at Berkshire, don't bet against US. Don't bet against India. Don't take my word for it. Okay. Look at history. right? We've had every problem under the sun. You had, you had a nuclear issue, you had wars, you've had just about every problem you could have, right? Everything. And still, look at it. If you just stayed invested, did nothing very wise, just stayed in the market, आपका 13-14% बन गया ना, that's plenty. That's plenty for the average investor. So my suggestion is just stay the course, stay there, and you won't be disappointed.
That's absolutely correct and perfect, I would say. Thank you. Anunaya, your words of wisdom for the new retail investor.
I think I'll also go to Mr. Warren Buffett when he has said two things, two rules for you to create wealth. One is that first rule is don't lose money. And the second rule is don't follow the rule number one. So I think that's very, very important. When we make money, let's be honest to ourselves. Has that, and I'm talking about the people who normally takes the approach of direct equities and all. So has that happened because you really carried the skill? Or has that happened because the Hertz approach helped you create wealth? I think that understanding is very, very important, because that's where the mistakes and turning into blunders, I think that starts the building up. We all have seen during the COVID time, the options volumes have just spurted because people thought that's a very easy way to make money. You buy calls and a put at a certain price and the price starts multiplying. And then you start, going and boasting about it to say, look, I exactly knew how to build and how to make the money. But when the reverse happened, then they start saying, that the market is not a place to be in. And so nothing wrong with the market. The beauty is last 10 years, if you look at, I don't think anything that could speak well for the market hasn't it happened. Right from your demonetization to your COVID, I'm talking about subprime crisis, to the devaluation of yuan. But anything that can disrupt the market, I think has all happened in the last 10 to 12 years. But where were we? Couple of months back, we were at a lifetime high. What was the message? The message is that please, when you are looking at investing the money, please do not leverage. That needs to be your investable surplus. Why investable surplus? Because then you can leave the money during the bad times as well. Markets, there are enough signs which has proved that the market over a period of 10 to 12 odd years have delivered 12, 13 compounded annual growth rate. So nothing wrong. Nothing wrong. What makes right or wrong is your approach. As long as you are disciplined and let the right man do the job. We can't expect a doctor to start doing an engineering kind of a job. So, as for example, when you have a medical emergency, you pick the right doctors. This is nothing short of your financial emergencies. Why are we casual doing these things? We should pick the right managers, right advisors, take the right set of advisors, don't speculate, follow the discipline, and then travel the course. I think that's what I would want to leave it as an advice.
Thank you, Anunaya. Thank you all the panelists. This has been a very engaging and interesting discussion. Thank you, Kamal. And I think over to you, Aishwarya.
Thank you very much to our moderator, Miss Ami. I think you've very ably brought out the best from this panel. And not just that, there are so many learnings and takeaways from this session. And I think the steering of the session was fabulous. Thank you so much once again, ma'am. And with that, I'd like to thank our esteemed panelists as well. I'd like to thank Mr. Shahzad Madon, and I'd also like to thank Mr. Anunaya Kumar and Mr. Aashish Somaiyaa very much for such valuable insights.